Hello, everyone, and welcome to Financial Accounting. Today, we will look at cash and stock dividends and how they are recorded. Stockholders receive a return on their investment in two ways: increasing the market value of the stock and cash dividends. To pay a cash dividend, a corporation must have the following. First, sufficient retained earnings to absorb the dividend without creating a deficit. Second, enough cash to pay the dividend. And third, final action by the board of directors is necessary to declare a dividend. Dividends are not legally required, but rather are declared at the discretion of the board of directors. When dividends are declared, it creates a liability. Some profitable corporations don't pay dividends. For example, a corporation may be in an early stage of development and may need to save cash to purchase property, plant, and equipment, repayment of debt, or for other needs of the company. These companies may not be able to get sufficient financing at a reasonable cost to finance their operations. As a result, they must rely on their earnings to provide the cash and other resources to run the business. It is not unusual for the board of directors to begin paying cash dividends to its stockholders after many years of profitable operations. There are four important dates to remember when discussing dividends: the date of declaration, the date of record, the ex-dividend date, and the date of payment. Date of declaration. On the day the board of directors declares the dividend, a liability to make the payment comes into existence. The date of record follows the date of declaration, usually by 2 or 3 weeks. It is stated in the dividend declaration. To be eligible to receive the dividend, a person must be listed in the corporation's record as the owner of the stock on the date of record. The ex-dividend date is important for investors in companies whose stock trade on stock exchanges. It is customary for the stock to go ex-dividend 3 business days before the date of record to permit the compilation of the list of stockholders as of the record date. A person who buys the stock before the ex-dividend date is entitled to receive the dividend. On the contrary, a stockholder who sells shares before the ex-dividend date doesn't receive the dividend. A stock is said to be selling ex-dividend on the day that it loses the right to receive the latest declared dividend. Date of payment. The declaration of a dividend includes an indication of the date of payment as well as the date of record. Usually, the date of payment comes 2 to 4 weeks after the date of record. Note that journal entries are required only on the dates of declaration and of payment, as these are the only transactions affecting the corporation declaring the dividends. Now, let's look at an example. On March 1st, Matrix Corporation declared a $1 per share dividend on its 500,000 common shares outstanding. The dividend is payable on May 1st to stockholders of record on April 1st. The journal entry on March 1st includes a debit to dividends or retained earnings and a credit to dividends payable of $500,000. The dividends decreases retained earnings. Remember that dividends are increased by debit and liabilities are increased by credit. If you would like to learn more about the stockholders' equity and related rules of debit and credit, consider watching the video Stockholders' Equity and Accounting for Paid-in Capital. I'm posting the link to this and other helpful videos in the description box. The ex-dividend date is an important date for the buyers of stock. This is the date that serves as the ownership cutoff point for the recipient of the most recently declared dividend. If you buy stock after this date, but before the payment date, you will not receive the dividend. Who owns the stock must be known on the April 1st record date, but an accounting entry is not needed. Let's look at the entry for May 1st to record the payment of the dividend. On May 1st, the payment date, Matrix would debit dividends payable and credit cash for the $500,000 dividends. We debit dividends payable as liabilities are decreased by debit and credit cash as assets are decreased by credit. Let's look at one more example. Review the information provided about dividends. On June 1st, a corporation's board of directors declared a dividend for the 2,500 shares of its $100 par value, 8% preferred stock. The dividend will be paid on July 15th. Which of the following will be included in the July 15th entry? Take a moment to think which answer is correct. July 15th is the payment date. The entry included a debit to dividends payable and a credit to cash for $20,000. Sometimes corporations will distribute additional shares of stock as a dividend. Reasons for doing this include keeping the market price affordable by increasing the number of shares outstanding and providing evidence of management's confidence in the company. In accounting for a relatively small stock dividend, equal or less than 25%, the market value of the new shares is transferred from retained earnings account to the paid-in capital account. This process is sometimes called capitalizing retained earnings. On June 1st, Aspen Corporation has outstanding 1 million shares of $1 par value common stock with a market value of $25 per share. The company declares a 5% stock dividend on this date. The dividend is distributable on July 15th to stockholders of record on June 20th. Let's look at the journal entries. We begin by determining the amount that will be assigned to the stock dividend. The company has 1 million shares of common stock outstanding. We multiply the number of shares times the stock dividend percentage to get the new shares that are issuable. In our example, 50,000 are issuable, and we assign the market price of $25 per share to arrive at the value of the dividend of $1,250,000. Because 50,000 new shares will be issuable, the total change in the common stock account will be $50,000. On June 1st, Aspen declared a 5% stock dividend on its 1 million common shares outstanding. The entry on this date is to debit dividends or retained earnings for the total amount of $1,250,000, credit stock dividend to be distributed for $50,000, which is 50,000 shares issuable times $1 par, and credit additional paid-in capital stock dividend for the difference of $1,200,000. The stock dividend to be distributed account is not a liability account because there is no obligation to distribute cash or any other asset. If a balance sheet is prepared between the date of declaration of the stock dividend and the date of distribution of the shares, this account, as well as the additional paid-in capital stock dividend account, should be presented in the stockholders' equity section of the balance sheet. Notice that retained earnings account was reduced by the market value of the shares. The ex-dividend date is the date that serves as the ownership cutoff point for the recipient of the most recently declared dividend. If you buy stock after this date, but before the payment date, you will not receive the dividend. Who owns the stock must be known on the June 20th record date, but an accounting entry is not needed. On July 15th, the distribution of the 50,000 common shares is made to the stockholders. The entry is to debit stock dividend to be distributed for $50,000 and credit common stock for the same amount. Recall, the additional paid-in capital was recorded on the date of declaration in the amount of $1,200,000. If you were the owner of 100 shares of common stock prior to the distribution, you would receive 5 shares in the form of the dividend and would now have 105 shares. Management often finds stock dividend appealing because they allow management to distribute something of perceived value to stockholders while conserving cash that may be needed for other purposes. Stockholders like stock dividends because they receive more shares. Often the stock price doesn't fall proportionally. Also, the dividend is not subject to income taxes until the shares are sold. The difference between a stock dividend and a stock split lies in management's intent and the related issue of the size of the distribution. A stock dividend is usually intended to substitute for a cash dividend and is small enough that the stock's market price is relatively unaffected. Stock dividends don't result in a change in the par value of the stock. On the contrary, stock splits result in a pro rata reduction in the stock's par value. A stock dividend can be classified as small or large. A small stock dividend is a distribution of stock that is less than or equal to 25% of the outstanding shares. A large stock dividend is a distribution of stock that is greater than 25% of the outstanding shares. Stock splits are the distribution of additional shares of stock to stockholders according to their percent ownership. When a stock split occurs, the corporation calls in the outstanding shares and issues new shares of stock. In the process of a stock split, the par value of the stock changes. Take a moment to review the impact of a small stock dividend, a large stock dividend, and the stock split on the financial statements. Stock dividends and stock splits don't affect total shareholders' equity. Common stock is increased by stock dividends, but not by stock splits. Paid-in capital is increased when small stock dividends are issued. It is not affected by large stock dividends or stock splits. Retained earnings are decreased when stock dividends are issued, but are not affected by stock splits. Both stock dividends and stock splits increase the number of shares outstanding. And finally, only stock splits decrease par value per share. I hope you found this video helpful. If you did, please make sure to subscribe, hit the like button, and ring the notification bell so you are notified when we release more videos like this. Thank you all so much for watching, and I hope to see you all again in the next video.